Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage-eitel.
All right, you heard the man. My name is Mark-eitel, host of the Mr. Mortgage Show, and we do this every week at the same time right here on this same station. So thank you so much for joining us. You, my friends, are in the right place this week if you want to walk away from this episode with the information that you need to make better mortgage and real estate decisions for you and your family. There is a lot going on. We're going to dig into it. I'm getting a ton of questions during the week. What the heck are going on? I'm getting a ton of questions. What in the heck is going on with real estate? I mean, one more time, Tom. I'm getting a ton of questions. What in the heck is going on with mortgage interest rates? Are these rate hikes going to burst the bubble? Are we in a bubble? What is happening? Are we seeing demand slow? We're going to dig into all of that. I know there's a lot of concerns surrounding all of those topics. So I've taken a bunch of questions from the week, and I'm going to weave them into some answers during the show, as well as take all of your questions. So to get your questions to us, the Anytime hotline is 561-291-8569. That's 561-291-8569. As always, you can call or text those questions to that hotline number. Dom, my producer, is here. He's running the board as well as the hotline, so he'll be the guy that answers the phone and gets you on the air or get your question to me. So, and if you're not comfortable calling in, just shoot a text to that number, 561-291-8569. And I just want to throw this out. We built a new Facebook page for the show, and we're using that to host all of the articles and the data sets that we use, that we talk about on this show, so you can read the articles yourself, dig deeper, and see where we're getting this information and kind of get into the mind of Mr. Mortgage, if you will, and get an understanding for yourself, what's going on. But as always, we are happy to take your questions directly on the air. 561-291-8569. Again, I'm Mark-eitel, host of the Mr. Mortgage Show. So happy to be with you. So not a lot of earth-shattering news this week. I mean, the Fed came out on, I believe it was Tuesday or Wednesday, and basically said, guys, hold on. Inflation's out of control, and we are, determined to quell inflation. And the only way they can do that is raise rates. They've insinuated the next rate hike is 50 basis points. This is nothing new if you're a listener of the show or you follow us on social media. We've been talking about this for a long time. We've got some great strategies that we'll cover in this show to kind of work you through all that. But hey, inflation is here, and we need to kind of put out that fire. It's kind of startling, though, when you listen to these guys who are telling you, and I'm talking about the Treasury Secretary and the Fed and the whole team up there. They're telling you, it's out of control. Don't worry, we've got this. They're the same people that told us, hey, don't worry, inflation is transitory. So it's just kind of ironic that it's always after the fact, right? It's like cleaning up after the storm. But anyway, the reality is, even where rates are, they're super, super low. So I just want to throw this statistic out, and I'm not going to bore you with a bunch of stats, but the lowest 30-year fixed rate ever recorded by Freddie Mac in their report, that I'll actually put this in the Facebook page, was 2.68%, and that was in December of 2020. So when you're talking about a rate in the fives and your only perspective is 2.68 from the all-time low in December of 2020, of course, 5.5 looks like a big rate. But to put this in further perspective, the highest ever recorded was 18.63% in 1981. So looking at 5% from there, this looks like free money. So just keep everything in perspective. The sky is certainly not falling. We're gonna cover a lot of the data around this to kind of support some different opinions. So anyway, let's dive right into your questions. I know we've got a couple that already came in, and then I'll get to the ones that I brought with me. But let me throw it over to Dom and see what we have for questions.
All right, Chris shot us a text. Chris is asking, are you still doing the free appraisals? I used to hear you talk about that. How can I get one?
Hey, Chris, that's a great question. So I think what you're alluding to is the free value report that we used to, and I don't know if we still advertise that or not, but yes, I'm happy to do that for you. It's not an appraisal. It's just, it's a desktop evaluation tool that we as lenders use to get a quick value determination on a property. It's pretty close to the appraised values. I mean, it runs really close, but I don't want to mislead you. It's not an appraisal. It's about a 10 or 15 page report. It's a pretty interesting report. I'm happy to do it for you for free. Hit the website freevaluereport.org. That's O-R-G, not .com, freevaluereport.org. Just type in your property address and give us your email, and we'll shoot you back that report. But happy to do that for you. Hey, Dom, do we have any other questions?
We do. Rhonda left us this on the hotline. Rhonda's asking, I read the headlines. Rates are way up. Big mortgage companies are firing people, and home prices are still going up. Aren't these signs we're in a bubble?
Well, yeah, so that's a great question. And it kind of alludes to what I was talking about. Actually, there's a video on the Facebook page that I posted last week that talks right to this. So you're right. All of that, it sounds super scary. And if you're defining a bubble by a rapid appreciation cycle, then yes, we're in a bubble. If you're defining a bubble by something that's going to burst, I'm of the personal belief that the bubble is not going to burst. I think what's going to happen is appreciation is going to flatten and allow it to catch up to itself. So we've seen, 10 years worth of appreciation in 2 years. So there's two logical solutions to that, if you will, just from a pure, I don't know what the term I'm looking for. My hands are waving around in the air as I'm stumbling around for a term, but I guess ways for it to self-correct, right? The bubble bursts and it comes back to where it's supposed to be. So we erase 8 years worth of appreciation that we had, I just mentioned 10 years in 2, or we go into a flattening appreciation cycle for the next 8 years and allow it to catch up. My personal belief is that's what's going to happen. And I don't know that 8 years is the number. I'm just using round numbers for conversation's sake. But I believe that we're going to go into a slowing appreciation cycle, and home prices are going to ease in some areas, not all, for a whole litany of reasons. And that video that I mentioned on the Facebook page goes into it in great deal. But a lot of it has to do with what got us here this time versus what got us here in the early 2000s. And some of you know, some of you don't. I started in the mortgage business in 1999, grew up in a family of home builders. So I've been in real estate my entire life, and I'm an old man now, so I've seen some things. The cycle that we were in the early 2000s was very different. It was fueled by artificial demand. And by artificial, I mean one person was buying multiple properties with interest-only adjustable rate mortgages. So they were using very risky mortgage products to buy a bunch of properties. They owned several. When those rates started to adjust and they could no longer afford those payments, they then were forced to sell. Now, that worked in the beginning when properties continued to appreciate. They were selling as soon as the prepayment penalty expired. They never were suffering from that adjustable rate. Great. That worked for 3 or 4 years as we moved into that cycle. Now, later in that bubble cycle, at the same time, all of those adjustable rate mortgages came due. That one individual didn't put one for sale sign in the yard. He had multiple for sale signs in the yard. So a flood of inventory at the very same time that the secondary mortgage market liquidity in the subprime, those dangerous loans, dried up. So there's no more easy money. Now, even if easy money didn't go away, I think we still would have had a problem because he was trying to sell 10 properties. It would have taken one guy, or 8 properties, whatever it was. It would have taken one guy who wanted 8 properties to make that an even transaction, demand to supply, even it out. So this time around, and I'm going to close with this time around, we have fully underwritten fixed rate mortgage products that are being used to buy properties. So people are either getting a fixed rate, 10, 15, 30-year fixed rate, fully underwritten, no stated income, no stated asset. We're looking at everything, and or paying cash. So there's no payment shock in the future that's going to force them to have to sell. Couple that with they're buying their primary home. So they're not going to lose that home if they can avoid it. They're going to lose the car, the boat, everything else, but they're going to keep the home. So, hey, check out the Facebook page. There's a long not long, it's about 15 minutes, 12 minutes. It explains all of this in length. But you hear the siren behind me. That means Dom is chasing me out of the seat into a break. We'll be right back in 2 minutes to take your questions. Give us a call at 561-291-8569. Hey, it's mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is mark-eitel. I host the Mr. Mortgage Show every week right here, same station, same time. So thank you for joining us. I know I kind of rushed out of that explanation, and I did promise everybody that I was going to cover some of the questions that have come in during the week. So that's one of the big ones, and I just want to kind of summarize that because I get very passionate about this. But in the bubble bursting phase, we saw, single individuals with multiple properties with interest-only adjustable rate mortgages, and their strategy was to put a tenant in that property and cover the mortgage expense, which was interest only at a low introductory rate until it adjusted or the prepayment penalty expired, and then they could sell it. So these people were racing out buying multiple properties. And we saw people with, 8, 9, and average people, regular working people who used stated income, stated asset loans to buy these properties. And when those payments adjusted, there was no one left to hand the hot potato to. No one wanted to buy 10 houses from this guy. That started the inventory glut, which was magnified by the fact that the secondary mortgage market dried up for subprime loans, and supply and demand is what controlled that market, not cost of money. So there was a ton of supply with very little demand, and the prices went down, and then it just spiraled from there with the foreclosures. This time around, we're seeing single families buying their primary home. This demand it may have been fueled by COVID and the artificially low interest rates, but it was genuine demand for housing. They weren't trying to flip it. They were looking for a primary residence, and most people were seeing maybe a second home, maybe one or two investment properties that are legitimate investment properties, right? They're rentals, they're fourplexes, they're duplexes, they're legitimately an investment property. So very different landscape. And then lastly, I'll close with this. They're using fixed rate mortgages and cash to buy these homes. So there's not a payment shock in the future that's going to force them to have to sell. And again, I'm going to reference the videos on the Facebook page. There's one about bamboo toilet paper, which which is talking about supply and demand. And the other is the one I just mentioned, where we're talking about 6% interest rates are not going to burst this bubble. So hopefully that helps. I'm not going to touch on that anymore unless there's additional questions, because I want to keep this party rolling and get to your questions. So I'm going